Hi, it's Tuesday, March 11, 2025. I'm Zach Howard. Here's your 3-minute morning market update. In my notebook today, what I'm looking at, collateral. That's something that I see as front and center as a clear and present danger to this current equity sell-off. Haven't seen market commentators really weigh in on that, but we've built these all-time highs in US equities and these mega cap, trillion-dollar market cap companies like Nvidia, Tesla, etc. off leverage. Leverage through margin loans is significantly built into the system, whether it's the retail holder of those shares or even the CEO of some of these large companies like Tesla. We had most recently in February, the CEO of Interactive Brokers come out and said they've seen the most highest volumes of leverage and margin loans in the history of their company. Fast forward to a month later, and now we had this big equity sell-off. Those previous margin positions are now underwater. The counterparty is saying here you need to put up some more prestige money good collateral, fiat money or something else to secure your position, which could potentially lead to more forced selling. We see that oftentimes in some of the higher beta names like the altcoins, where there's a lot of margin baked into some of these valuations, which further leads to cascading of selling when margin calls happen. Margin calls on famous CEOs is something not new. Aubrey McClendon of CEO Chesapeake Energy years ago, ultimately amount of margin risk he took on with his stock holdings position forced his liquidation and eventually the downfall of that company. LTCM in 1998, it blew up based on a lot of leverage. So we have been in this historic risk-off times before where cascading selling accelerated through margin calls. Just something to keep an eye on. Next up, also related to collateral, is the carry trade unwind potential. Not just in Japan, but now looking at European government bond yields rise. We've seen the highest yields in Japanese government debt in decades. The Japanese 10-year bond now 1.5% was negative for years. German bond yields had negative interest rates for years. Now at cycle highs approaching 3%. When a bond yield rises, the value of that bond falls. The higher the duration of the bond, the more receptive it is to risk off when yields rise. So from a mark-to-market standpoint on the value of some of these bonds, the counterparties could be saying, we now need extra collateral to make up for the loss that's potentially there on paper if we had to liquidate those bond portfolios today. Something to keep an eye on, particularly as FX currencies rise. Seeing euro rise against the US dollar, the Japanese yen against the US dollar, this all interplays with those bond yields and have counter effects on those other global markets. Thirdly, to those 2 points on carry trade unwinds and collateral. One asset class that doesn't have a lot of disclosure in terms of prestige collateral and mark-to-market values is the private equity space. A lot of potential dead bodies out there in private equity land if they were to have real mark-to-market values and some of the valuations they've used to purchase these businesses over the last 5 to 10 years. So those are the 3 things I'm looking at: collateral, counterparty risk, and the private equity space. I try to put that in the back of my mind as 2025 continues to be a risk-off year and other areas to consider risk and where it could come from. Risk happens slowly, then all at once. So keep an eye out there. Have a good day. See you tomorrow.